welcome to our webinar for September SDS after the summer break. Hope everyone had a nice summer. We like to do these different kind of webinars across the sector, and I attended a conference fairly recently, and Natalie and Brendan were speaking, and I went to their seminar, and it was quite interesting. Slightly different take what we normally do. Obviously, SDS provide software viability products in the sector, namely ProVal, which does lean on interest rates, loans, and the way the sector is moving. So I thought it was a very good subject matter to kind of explore and find out a bit more on. I'm not an expert on ESG, but ESG is kind of emerging more and more in different sectors, and obviously us being on the forefront of change, that it has come onto our sector a lot more. So I thought it'd be a really good opportunity to have two kind of leading people in the sector to talk about that subject matter. ESG stands for kind of environmental social governance, and it's obviously, as I said, emerging in the sector. So Natalie, if you introduce yourself, please.
Good morning, everybody. I'm a partner in the Leeds banking team at Devonshire Solicitors. So I specialise in all aspects of real estate finance, but focus predominantly on social and affordable housing finance. So your lending facilities with high street banks, your private placements with investors. And I trained previously at Addleshaw Goddard, so I've worked lender side, but now I'm exclusively working borrower side for housing associations. So hopefully there'll be a few clients attending and listening on the webinar, and I'll just say I'm happy to take any questions after the webinar. You'll be provided with my details. So I'll pass over to you, Brendan.
Thank you.
Natalie and I spoke together at that conference. Andrew was talking about I'm the straight man, and Natalie does all the jokes, just putting some pressure on her there. So I'm Brendan Sarsfield, Chair of Sustainability for Housing. Sustainability for Housing is an organisation that was set up by housing associations and the banks and lenders, investors, to try and manage the ESG space on behalf of the sector. And we've been going for just over 2 years, coming up to 2.5 years now. It's been an amazing journey, which I hope to share some of it with you in my presentation.
Excellent, good stuff. Okay, so normal way, questions. We'll have Brendan's presentation first, or talk, and then we can ask some questions afterwards, and then we'll go into Natalie's, and again, hopefully have some space for a bit of questions. You've got a couple of ways of doing your questions. The chat at the bottom, if you kind of highlight the screen, you should see a chat at the bottom, and we'll monitor that, and kind of we'll pose the questions, or I'll ask the questions, follow-up questions at the end. So let's get started. Thank you guys for attending. Brendan, are you sharing a presentation? Have you got that at the bottom, or are you just going straight?
Never do them.
Yes, I thought so. I thought that was the case, but that's good. Okay.
I normally just have a beer in my hand, but it's a bit early for that.
Well, it's 12 o'clock somewhere.
Just yesterday I moved house, so I'm a bit shaky that journey. Anyway, so first of all, I thought the title, Demystifying ESG, great title. Really, I thought that was really good. So I've taken that title really seriously, and I think there's two ways that you can demystify this. One is strategically, why is it, the big questions, and secondly, you can look at it from the detail point of view as well. And I kind of, I know I've seen what Natalie's going to be saying, and I think the two of us are approaching it from the different ends. So I'm going to be trying to do the big picture end, and without being rude, Natalie, I think you've approached it from the detail point of view. And both are very valid approaches, and I think will be helpful in understanding ESG. So I think it's great that I'm going first, because I thought I was going second. So I'm going to try and talk about what is ESG. Where did it come from? Is it here for the long term? Should I be taking it seriously? Those sorts of questions are what I thought I would cover today, and I hope those will help. So first of all, what is ESG? Well, it's this acronym that Andrew mentioned: environment, social, and governance. And it's a strange collection to put together. Why have those three things come together? But I summarize it as an attempt to achieve ethical lending or ethical investment. That's what it's trying to grasp. It's trying to say, are you caring about the world? Are you caring about the people? And are you doing it properly? That's what ESG is, and that's what people are trying to understand in the lending. It's a growing share of the market. It's a specialist part of the market, ESG market, and it's now 36% of all managed funds in the world. So it's 1 in 3 of the managed markets, 1 in 3 pounds or dollars of the managed markets have ESG conditions attached to it, and it's growing. It's not getting smaller. It's been growing fast, and it's continuing to grow. And it isn't just a UK thing. It isn't just a housing thing. It's a worldwide, business-wide phenomena, and that's really important. And I'll come on to this a bit later, because I think the sectors has been always looked to the regulator for what it should do and what it should be, how it should be behaving. And actually, there's a bigger market. There's a bigger world out there, and that's beginning to influence what people are having to do and think about. And to give you an example, I mean, FTSE 250 companies have been having to report on their environmental impact for many years already, actually, and it's I don't know if it's statutory, but it's a requirement of them in their annual reports, and something that is voluntary in our sector. So people in our sector are struggling with it, but other people are getting to grips with it in other sectors a bit more. So why is the world interested in ethical lending when it hasn't been since time began? He said cynically, why is this suddenly trendy? Why are people bothered by this? And I think the answer to that is very simple, and that is the world has changed, and it's changing. Perhaps we all say it's the speed of change is increasing, and I think in this area it definitely is. So what's behind this? Well, the obvious thing is environmental issues. I think the environment is going up the political and practical agenda. Secondly, the role of active shareholders, is increasing. You think about the way pension funds and other people are now dictating to banks and how they are investing. I'm a trustee of a small charity, but has quite a lot of reserves, and we invest them, and we insist to a major bank that they invest them ethically, and that is what a lot of people behind the banks are doing. So behind the banks are people who are demanding things of them, and of course social media has created a huge impact on the world, because it empowers the activist, it empowers the small shareholder, it allows a small group of people to create a lot of noise around a company and what they're doing. And of course, political pressure is increasing, and I think a blame culture, particularly politically, is something that's sadly developed, and no one likes blaming a bank or a large company, more than a politician. So it's a way of pushing the blame somewhere else, and you see that more and more. You see, I think, when I was young, I had 4 TV channels. I only knew about what's happening in the UK, and the internet has meant, I read the New York Times every day. I check what's happening in the Sydney Morning Herald. You know, journalistic influence is wider. I watch Netflix. I watch Disney Plus. You know, Ted Lasso. I've got to watch that. You know, and you've got to. And I think the way people get their news and the opportunity for bad stories to develop around your business are much greater than they were. And all these things, I think, combine, because actually, I think if any business, you know, when I was at Peabody, reputation was probably my number one on my risk map. And it is on most businesses. How you can, if your reputation is damaged, the financial and it can ruin your business. And so actually, reputational risk management is behind this, I think. And so the banks and the investors do not want to be criticized for investing in things that will cause problems in the world. So we've got to. I spent a bit of time on this, Andrew, because I feel you've got to understand where the world is going to see whether it's important to you or not.
Is this, I mean, the follow-up question on that, is being driven by more younger people, more younger kind of generations wanting to see more clarity on this subject?
Well, yeah, I don't know is the answer. You know, you would, if you were, you know, if we were talking in the pub, I'd go, yeah, you know, but I really don't know is the answer to that. Mm-hmm. But actually, that trend for I want to know what you're doing with my money, mm-hmm. is definitely behind all of this, and we don't want to make sure our money's, you know, going to the wrong places is interesting. So, you know, moving on from that, sadly it's developed in a very complicated way, and it's not developed as easily as it could have done. So the banks and the investors, you know, they turn to social housing and they don't understand it really. But why should they? They don't understand every industry. They can't. So basically, they ask you, rather than the 5 most important questions that help them understand you, they ask you 100 questions. You know? And each bank has a different 100 questions, and each bank has a different way of, they want it measured differently. So around this, there's grown up a bureaucracy, and that's made things very complicated. And secondly, some banks bend the rules. I was talking to a bank the other day, which was talking about, well, they have lending to the oil industry as part of their ESG investment. Yeah. You know, and that's because it's because those guys are the ones that are going to make electrical transport happen. Okay, you can argue anything, you know. You know, the military has become part of ESG in some places. You know, investing in bonds because security is part of protecting the environment. So I think, well, hang on. So some of it's gone a bit funny. That's what I would say, honest. And when you look at the detail, and then others, you know, and then there are people who write ESG reports which tell a few porky pies too. So, you know, some of the reporting on the way people say what they're doing isn't always true either. So you've got this market where it's an immature market, is how I would describe it, where the people asking for information don't know what they want, and the people giving it sometimes exploit that. So it's a strange thing. And then if I layer over that, is actually the whole world is learning about this. And so the rules are changing all the time. And we have, you know, the different codes and worldwide codes, European codes, American codes, which all the banks listen to and say, oh, we now need this information, we need that. So it is getting very complicated and it's evolving. And if I can give you an example, if you went back 5 years, nobody was talking about biodiversity. But now people recognize that biodiversity is one of the issues that we've got to think about in net zero journeys, because the damage that more than 1.5 degrees increase will have on the biodiversity. So what's your impact on there has become a question that didn't exist a few years ago in ESG lending. So I'm not selling this very well, am I? So, you know, but what I'm trying to do is show you a complicated world, really. And then in the US, you've got the political right, who are anti any way you invest your money and things. And so there are campaigns against ESG that make the press, etc. So there's a lot happening out there which make it complicated. But the way I've described that a minute ago is I think it's a market that isn't mature yet.
Yeah.
And it will mature. And what I think will happen, it will settle down. And I'll explain why in a minute. So why bother? So the first thing for me is I think it could become the major source of funding in social housing. Social housing is a great place to put your ESG money. And if you said, you know, we've got X billion to invest in ESG, I'd say, well, we know it's safe in social housing. The greenwashing isn't going to happen. We know it's going to a good social purpose. We know they're doing things on the environment. Let's make all our lending to that sector ESG focused. So I can see in the future this becoming not just a bigger proportion of investment money generally, but I think even bigger in social housing. Although I've described a very complicated network of why people want different things and why things are changing. People are trying to codify and make this simpler. And Sustainability for Housing has the Sustainability Reporting Standard, which we try to codify and make this easier for all. So over 100 housing associations now use the SRS, the Sustainable Reporting Standard. 35 of the major lenders use it, and many of the consultants and endorsers around the sector use it too. And this has become very influential in the sector. Many of the major players use it. I think we cover about 2.2 million homes from the people who use the SRS in the UK. The 35 lenders that use it actually have lent over 130 billion to the sector. So bringing all that mess is people trying to codify it, make it simpler, but we've got to move with the world because the world is moving quickly. So what you have to do does change and gets out of step. But actually there is a way through this. And despite, you know, you might want to ignore it, but it isn't going away. We're having growing pains in doing it, but actually the scrutiny isn't decreasing. The environmental problems aren't decreasing. The political issues aren't decreasing. All those things I described earlier are rock solid. So how this works is not going to go away. This is going to be here for the long term. So, you know, if you don't have to use the Sustainability Reporting Standard, he says, you know, it's not compulsory. You can get ESG money, which through one-off deals, etc. But also there are other sources of finance. We know that there's a lot of money out there. But if you're working with the 35 major lenders to the sector, what they tell us is the first question they ask you when you sit down with them is, are you using the SRS or not? And if you're not, that's fine. But what are you doing instead? So you can't, if you're not using it, you need something equivalent along the way. And reporting and doing ESG reporting isn't easy. I describe an annual report as you giving stakeholders information you want to tell them. What sustainability reporting doing is giving stakeholders information what they want to know, not what you want to tell them. And that's harder because the data isn't always there that they want. It isn't always in the right place in your business and has to be pulled together. So it can be a faff to try and get your head around and make it work. But actually, what I would say is I actually think what lenders want to know is also what your residents want to know, what other stakeholders want to know. People want to know what you're doing in the environment, social and governance space. And it's a useful tool that goes beyond lending and can help you in communication. So look, I've talked a lot. Just to conclude, really, ESG lending and reporting are growing trends. It's something that's becoming more important. And they will be more important in the future. There are other sources of finance out there. You can go elsewhere. But even if you don't want to borrow money or need to and don't want to report, I really think that the SRS and thinking about what stakeholders want is something that the modern landlord has to do and not just respond to a regulatory demands. So there's my big picture, which has sent everyone to sleep and confused them. But
painted the picture, Brendan.
But there we are.
Yeah. Okay.
Natalie, wake them up.
Well, thank you for that. I mean, if there are any questions, please post them. I think probably best that we go straight into kind of Natalie's kind of presentation, and then we can collate them and we can debate a few questions that arise from that, which would be a good part. So stay on, Brendan, if you can. That'd be great. Over to you, Natalie.
Yeah, just thank you, Brendan, for the introduction. And I think it's always works well when you set the big picture and then you say people are asleep and they can perhaps fall asleep to the minutiae of the detail that we'll get into. But I would echo Brendan's sentiments around ESG is not something that can be ignored now. Even if you don't want ESG related lending, there is an expectation that over the next year, 2-3 years, that you will be issuing some form of sustainability reporting within your annual report if you're not doing that already. And if you're not doing that, your lenders will be asking you for that information and why that's not being made available. But what I would say, the positive that I think Brendan's identified is that the social housing sector lends itself very well to ESG based lending, because there is a lot of good work that's done, and the challenge that we have is, do we have the data to show to evidence what we've done and what we are doing and where we are going? And I think there's an inherent issue in the sector sometimes around data collection, data capture, and data interrogation and verification. So sustainability and the need to report on that might be one of the drivers that actually helps address that data issue. And I know that Brendan and I have discussed that previously, that your data is integral. Your data is everything. Your reputationally, your data is key as well. So so thanks, Brendan, for the introduction. I do have some slides, and they'll be made available if you'd like them after after the webinar. So I'll just share those now, and then get started.
Yeah, thank you.
So just to check, can you see them?
Yes,
okay.
yeah, that's good.
Excellent. So my contact details are there if anybody's got any follow-up questions or would like to discuss anything. But this section of the webinar will focus on the finance aspect and the documentation and how you might approach ESG funding with your lenders. So just bear with me 1 second. Yeah, so there's sort of 5 strands to what I'll cover now, drawing on from the big picture that Brendan set. So we'll talk about what constitutes a green loan, a social loan, and a sustainability linked loan, because I'm sure many of the people watching this webinar will have heard these words but might not understand the different types of finance available. Why sustainable finance has become increasingly important to funders. I think Brendan's already covered this off in the round, and there's just a couple of specific reasons on the slides that we'll come on to around regulation and statutory intervention and protocols that are now obviously mandatory from a reporting perspective. The LMA principles and drafting recommendations, the Association of Corporate Treasurers guidance on the information that's been produced and the principles of the LMA, which is freely available, and I've included a link within the slides because that can be a really helpful document to read if you are about to or in the process of navigating ESG related funding. The LMA obviously is the Loan Market Association that produces template documentation and guidance with the input of the major banks, the investors and the relevant sectors their documentation relates to. So lots of funders look to LMA guidance and look to adhere to LMA principles and drafting recommendations. So that guidance note that was produced would be really helpful for a follow-up if anybody had any questions specifically as part of negotiations. And then some practical considerations in agreeing and negotiating sustainable finance. And again, some of these Brendan's already touched on, but I think it'd be a nice conclusion to our webinar just to come back to those. So the three types, broadly speaking, of ESG finance available are sustainability-linked loans, green loans and social loans. So the key distinction between these three products are that a green loan or a social loan has to be, the proceeds of that loan has to be used and applied to a specific agreed green project or social project. You have to track the drawdowns and you have to track the application of those monies to that project. And that has to be done in a very transparent manner. Otherwise, that would obviously undermine the label of a green or a social loan. Sustainability-linked loans are far more common in the sector and far more common across all sectors. And the key reason for that is that it provides you with more flexibility. So you can use the proceeds of the loans drawn for the purposes that are agreed and included within your loan agreement. So generally speaking, you would have a general purpose clause or perhaps a refinancing clause, but essentially anything that you're permitted to do within your constitutional objectives that doesn't cause a breach of legislation and is in line with your regulatory framework obligations. So on a sustainability linked loan, what happens is that you agree a set of targets that you will meet based on a set of KPIs that are agreed. So typically we see between 2 and 4, possibly 5 KPIs agreed. So the KPIs are things like, for example, energy performance on existing units, energy performance on new units, the hiring of apprentices would be common things that we see in our sector, that things that all housing associations are already engaging in. And the beauty of a sustainability linked loan is that it can tie into your wider strategy, but provide you with a cost saving. So essentially the margin or the coupon, if this is an issuance of notes, is linked to your performance against a set of targets using these KPIs. So EPC rating of C and above, for example, and the number of units or the proportion of units a year on year increases in line with a set of targets that are agreed. I've just included, for the purpose of each of the slides where we talk about these different types of loans, a link to an article just to give you an idea of a recent deal done in the sector. Obviously, lots of deals aren't published, so these are just a couple of things that you could find very quickly through a Google, just to give you an idea of what other people in the sector might be doing and if it might be of interest to you. So a green loan, it's a use of proceeds product that we've just discussed. So the proceeds have to be applied specifically towards a green project. And the aim of a green loan is that it contributes to an environmental objective. So as Brendan touched on, this is something that provides a positive benefit to the environment. So some examples that are detailed within the LMA principle and guidance, and obviously widely regarded across all sectors, would be investment in renewable energy. Investment in energy efficiency, which links very well to our sector, given the retrofitting plans and programmes underway, and also green technologies. Green loans and also social loans are in their infancy, I would say, in our sector. In terms of, I haven't done a green or a social loan, and I've done lots of sustainable finance. The predominant product, as I mentioned before, is sustainability linked finance because of the flexibility. But a deal that was done in January this year was Vivid. So they had an ESG linked refinancing package, and within that they had a specific 50 million facility that was a green loan facility, and that had to be used exclusively to fund these 300 energy efficient homes. And there's a link there to the article in Social Housing that provides a bit more detail. Social loans, again, similar to green loans in terms of their operation. You need to apply the proceeds exclusively towards a social project. Social projects is interesting in the sense that there's no real consensus as to what would or wouldn't constitute a social project. So this allows some interpretation to be implied, a rationale to be provided to a lender as to why you think a certain project should be deemed a social project. But essentially the idea is that it would address or mitigate a social issue, and it might be that it's aimed at a specific target population. So, for example, people with disabilities, people living in poverty, vulnerable adults, ageing populations, for example. So some examples, albeit it's still an evolving product, I would say, are access to essential services, affordable housing, again, lends itself very well to our sector, and affordable basic infrastructure such as transport, for example. Again, I've included a recent deal there. The for-profit Legal and General Homes completed a very large social loan in September last year. But if you do a Google as to how many social loans have been in the sector, there'll be very few that will have been published. So again, it just reiterates the fact that the flexibility that comes with a sustainability-linked loan rather than a proceeds-based product makes them much more attractive. I think Brendan's already covered this in terms of the bigger picture, but in terms of why this is important, I think this has become more important to everybody. Obviously, we've got the net zero by 2050 under the Paris Agreement. I think we'll just skirt over the recent announcements as to how we'll get there and when we'll get there, and the scaling back in terms of the government's promises and obligations imposed on us. That's perhaps a topic in itself for another webinar. But just to give you a flavour of some of the regulations and protocols that the banks are subject to, there's the Task Force on Climate-Related Financial Disclosures. So that was established by the Financial Stability Board. And essentially the task force was asked to develop a voluntary set of principles whereby climate-related disclosures could be universally provided to allow the people placing their money and investing to understand the material risks related to climate change. So under those disclosures, you're required to identify and disclose details of material risks and opportunities that arise from climate change. And essentially these, the task force principles that were recommended, there were 4 strands. They're not specific to any sector or jurisdiction, so they apply across the board. And as Brendan had mentioned, obviously lots of FTSE 250 hundreds have been disclosing climate-related data for years. But actually from the 1st of April last year, over 1,300 of the UK's largest companies have actually been required to make this, and that's been mandatory. So there's some further details on that, but this is just to give you a context as to why the lenders are asking you the questions that they are asking you, because they've got to make disclosures around what their lending portfolio looks like and where they've placed their money. There's also, again, the Net Zero Banking Alliance. So this is industry-led and UN convened. It's essentially a group of all the leading global banks that have committed to financing ambitious climate action in accordance with the transition to net zero by 2050 or sooner. So there are 134 members signed up to that. I've included some of the names that I suspect people on this webinar will have funding with, but essentially, I suspect all of your funders will have signed to the Net Zero Banking Alliance. Each bank makes a commitment. Their chief exec formally signs a commitment confirmation, and within that, they essentially are committing that they will, within 18 months of joining, set their targets for their portfolios for 2030 or sooner to the 2050 target. And then in terms of the immediate targets by 2030, they ask the banks commit to focus on the sectors where they can have the most significant impact. So as Brendan mentioned, the banks that have got lots of investment in fossil fuels will need to tackle that first. Then they'll be looking at, the sectors that they invest in that still have an impact, but not the same significant impact, and how can they reduce that by 2050? They're required to publish annually in terms of their emissions across the lending portfolios in line with the various international and national protocols. And again, as Brendan mentioned, the issue here is that things are evolving at such a fast pace that it's hard for the banks to keep up, which is why we've got this myriad of questions that come through when you approach them around ESG related matters. There's also the Investment Association that have issued guidelines for HAs that are approaching the capital markets. And again, there's a link to that within the slides, but essentially that report's identified the need for greater transparency as to the performance, governance and their sustainability strategies generally. And again, Brendan's touched on the fact that transparency is ultimately key here. So their recommendations were you publish all relevant information and key disclosures on a dedicated part of their website. Many of the HAs have a dedicated investor relations section. So put your information where a lender can find it quickly and easily, make it clear, be transparent, publish your policies as well as how you're reporting, tell people your story, tell people your sustainability strategy, tell them the story that they want to hear, but also the story that's pertinent to you and your organisation. And a key thing and a key change in the market is the need now for external validation or opinions around your performance. So I've just checked time, but we've got plenty of time. But in terms of what does this look like if I have a conversation with a lender? What will my documentation look like? What do I need to be mindful of? The key documentation that's sort of helping from a documentation perspective when you approach a funder are the LMA principles. So the LMA has published principles, green loan principles, social loan principles, and also sustainability-linked loan principles. And they're essentially the guiding light from a documentation perspective. All the banks and their legal advisors look to these documents when they set the framework, the provisions, and the parameters within your lending agreement. So I'll go into a little bit more detail on these, but as I mentioned, the ACT guidance I'll come on to shortly gives a really good summary of what these principles do, how to interpret them, and really good opinion on those. So although LMA documentation is only available to LMA subscribers or through your bank as part of a transaction, that piece of guidance will give you a really good flavour as to exactly what the principal documents say. I would say that the LMA documents are quite short and sweet. They're not long-winded, and that's in recognition that you can't be too definitive as to what's acceptable today and what will be acceptable tomorrow. They recognise, as does the sector generally and the funders, that this is an evolving topic, and what constitutes a green project today might not be a green project tomorrow. What constitutes an ambitious target around sustainability today won't be relevant in 4 years' time. So just touching on each of these principles in a little bit more detail then. So a green loan is designed to support borrowers in financing environmentally sound and sustainable projects that foster a net zero emissions economy, protect and restore the environment, facilitate adaptation to climate change, and or provide for other environmental benefits. So that's taken from the LMA green loan principles, just to give you a flavour of green projects. There's a non-exhaustive list of things that might constitute a green project, but ultimately it's for you and the lender to determine if what you're suggesting is a green project, and the rationale and the evidence behind to support the fact that what you want to finance would be a green project. So we've already mentioned that you have to use the proceeds of the loan exclusively for the green projects or projects that are identified and agreed. You could have a loan that just has one green loan tranche. If that's the case, you cannot call the entire loan a green loan. So you'll note, if you were to look at the Vivid press release, it was specific in noting that there was a 50 million green loan as part of that package, as opposed to suggesting it's all a green product. That may have been within a wider loan agreement. You don't have to have just green loans within a document. You can have tranches. We've already touched on what would constitute, broadly speaking, a green project and how that lends itself well into the sector. In terms of evaluation and selection, you as a borrower need to communicate what your sustainability objective is for your project, how you've selected this project, why it fits and aligns with your overall sustainability strategy. And I think Brendan would hopefully echo the sentiments. You can't just go to your funder and say, we're going to finance a green project in something completely unrelated to what you're doing, that has no relevance to what you're doing, because that undermines the whole ESG story. What you really need is you need to have a strategy. And that strategy needs to be addressing things that are pertinent to your business or the customers or the environments that you operate within. So a green project for a housing association would probably be most likely linked to affordable, energy efficient homes, as the Vivid loan was, for example. In terms of management of proceeds, you need to track. So if you draw down your 50 million term loan, all 50 million of that term loan needs to be applied for the green project. That can include research and development as part of the green project. It can include something that's intangible and difficult to quantify, but you'd obviously have to agree that and set that parameter with your funder. And that would be something that would likely come up with discussions when you are agreeing your definitions within your loan agreement. In terms of reporting, the expectation is that you would have this information to hand readily, because if you're drawing loans and applying them for a project, you need to know what you've drawn, how you've applied it, and the impact and the outcome as a result of that application. But the expectation would be at least an annual reporting against the proceeds used and applied and the impact. So in the same way that you'll report compliance against financial covenants, the expectation is there would be an additional certificate delivered around the use of proceeds for the green loan. In terms of the green project itself and its suitability, the LMA does recommend that an external review process is undertaken. I think this is something, Brendan, that we as a sector have tried to resist because of the additional cost. And I think if the borrower has the necessary expertise that's been developed internally to tell that story to the bank, and working knowledge of ESG space generally, that should be something that could be dispensed with. And the LMA does recognise that in some circumstances, self-certification and that self-assessment of what is or isn't a green project is ultimately at the lender and the borrower's discretion, which I do think is helpful. And then social loan principles, I'm just conscious of time. It's very much...
It's good. It's interesting. It's good.
Yeah, social loan principles are very much drafted in and set up in the same way that the green loan principles are. I think the key distinction to make there is obviously they're applied for a social project rather than a green project, but all the other limbs I've mentioned, the same comments apply because it's a use of proceeds product. So in terms of actually what constitutes a social loan, ultimately the aim is to mitigate social issues and challenges and or achieve a positive social outcome. So that's basically taken from the social loan principles. This is still very much TBC, under discussion, open for interpretation, as I mentioned at the outset, as to what would constitute a social project, which is helpful. In our sector, it's probably access potentially to higher education or training for tenants to get them back into work would be a prime example. Affordable basic infrastructure would fall within a social project. So what we find in our sector is that a lot of the projects that we do would probably lend themselves to any of the three categories of funding, but the sustainability linked funding, because you don't have to track the use of proceeds, provides the greatest flexibility, which is why lots of lenders and borrowers opt for that pathway to funding. And then I think I'll move on to the sustainability linked principles. So I'll just shorten that to SLL because it's a bit of a mouthful. So the key this is a very different product, but gives greater flexibility. So just skip the slide. The sort of 5 limbs to the principles provided by the LMA. So the first one is selection of KPIs. So your key performance indicators need to be relevant, core and material to your overall business and of material strategic significance. So this is why in a lot of the SLL financing we do, there's a focus on EPC ratings. There's a focus on apprenticeship hire. In some, we've seen a focus on board diversity, things to do with tenant engagement, but the key ones are around energy. And I think obviously as we transition and as we move forward towards our net zero ambitions and our energy, our mandatory energy performance requirements, those KPIs will fall away. They won't become relevant because we'll just be doing what we have to do by the time that we do it. So I suspect in 5 years' time, Brendan, EPC related KPIs will largely fall away because we've already set some very ambitious targets within the sector, and there's lots of landlords doing lots of retrofitting ahead of schedule to help mitigate the cost of living crisis in terms of energy bills for tenants as well. So I think the KPIs we've seen 3 years ago have evolved. The KPIs we're seeing now won't be relevant in 5 years' time. They need to be measurable and quantifiable. You need to be able to benchmark them. So you need a KPI that you can measure and benchmark against performance of another association, for example, which is why EPC lends itself so well to being a KPI at the moment. And they need to be clearly defined. what exactly have you agreed? Is it clear in the definition? Does the definition work? Is it in black and white? Is it in plain English? All the things that you want your lawyers to get right that sometimes just get a little bit muddied in the drafting. Calibration. So you agree a set of KPIs, and you need to then agree what are your targets. How are you going to achieve something that's in line with your overall sustainability strategy, and what's your timeline for achieving that? So you need to set your targets in good faith, and they need to remain relevant. They need to be ambitious throughout the life of the facility, and they do need to represent a material improvement of your otherwise performance against that KPI, not just a business as usual. So whilst we're all on a journey towards EPC rating improvement, you couldn't agree just the fact that you get the EPC rating you need by the required date as a target. It needs to be ambitious. It needs to be stretching. You need to be doing something before you need to be doing it. Essentially, I think in a nutshell and in black and white, plain English. And I think, as I mentioned before, and as Brendan touched on, it needs to be consistent with your overall strategy. It needs to be core to your business. What's the benefit of you achieving that target? You know, the benefit from an EPC rating is cheaper energy bills for your customers, for example. Something that's changed perhaps more recently in the guidance is actually the need to define and set your targets either prior to execution or at the point of execution of your agreement. So we had what was known as sleeping SLL before, where a loan envisages that you might do some sustainability linked lending, but you hadn't agreed the KPIs and you hadn't agreed the targets. Now, you weren't suggesting it wasn't a sustainable finance document, but you're kind of half committed. So there's definitely been a move away from that now. So if you want to have sustainability linked provisions, you could have them embedded in the document and agree that shortly after completion, but it would have to be within a very specific time frame, and that would be an exceptional circumstance. So, for example, 3 to 6 months, I would say, would be the maximum. As part of setting your targets, you need to have a clear timeline for achieving them. So what we find now is there's lots of loans in the sector that are perhaps 5 years, whereas previously we had 10, 30, 15, 20, 25-year loans. I think it's quite easy, Brendan, perhaps to set targets for a 5-year period. But where you've got a facility where it goes beyond 5 years, how can you meaningfully set a target when with all the change that's going on in the sector? So what we are seeing now is recognition of that when we have conversations with funders, and we're seeing provisions built into documentation that where you set the targets for the first 5 years, and then there's a commitment to set the targets for the remaining life of the facility. And if at that point you declassify the facility, there's no event of default, but you can no longer call that a sustainable product. So that's really helpful. And that's been something that we've been butting heads over a little bit on some transactions where, the funder said, well, we need to agree everything up front because that's the guidance. And you can understand the rationale, but we don't know what is it going to be an appropriate target in 5 years' time, given the shift in the market and how ESG is evolving. So next one, loan characteristics. Essentially, the economic outcome, so the margin or the coupon that you pay, is linked to you achieving or not achieving a target. The most interestingly, I think this will change, Brendan, is that at the moment we generally see a one-way ratchet. So it's a reduction. If you don't achieve the target, you don't get a reduction and you have a baseline margin. We are aware of, and there are a few loans out there where it's a two-way ratchet. So you can actually there can actually be a penalty in not achieving the target. And I think we'll probably see more of that, Brendan. You're nodding your head, in the future. I think because, as we get closer to some of these really aggressive ESG related protocols and requirements placed on funders. But at the moment, to give some assurance to housing associations listening in, that we generally see a one-way ratchet with the bank if they achieve, perhaps if you don't achieve it, applying that perceived benefit that you haven't got to a social or green project at their own end. So they're not looking to profit from your failure to perform. Reporting. I can talk to this because I've done lots of SLL loans. Generally it's an annual reporting compliance certificate, and obviously for that you need up-to-date information. Verification, hot topic, definitely a move away from self-certification, and the LMA now is very clear that post-signing verification is a necessary element of SLO. So essentially, you will do your calculations, you'll have your data, but that has to be verified externally and an external assurance report provided. Typically, that's an extension to the scope of your auditor's mandate, but it will just depend on the KPIs you agree as to whether or not it's appropriate for them to be that external verifier. I would say external verification is still evolving, but at the moment we predominantly see the auditors undertaking that role, and that's generally acceptable. And I would just say that obviously there have been principles around since 2018, and they were all recently reviewed and updated in 2023, in February this year. I won't touch too much on the actual draft model provisions themselves, because I can't share them with you. But what I would say is that we're hoping, as a result of the LMA having published model provisions finally, that we'll see more alignment in terms of what you will have in your loan documents. I've done a couple of, I've done lots of refinances, but refinances where you've got different banks. And as Brendan mentioned before, they all approach it at a different angle. They all have slightly different requirements, but ultimately as a borrower, as with your financial covenants, you want alignment as far as possible across everything. You don't want to be providing one report on a Tuesday, the 25th of September, and everybody else would have it in December, which therefore brings you everything, you have to do everything by the 25th of September. So we're very hopeful, and we are seeing this more now, that lenders rely heavily and look heavily to LMA. So that should hopefully mean that we'll have greater alignment. What it doesn't mean is that you'll necessarily get the same targets easily agreed across a funding piece, but part of the selection of KPIs and the agreement of the targets is around the story that you tell the funders and how you demonstrate why the KPIs are appropriate and why the targets are stretching and ambitious. I would say LMA drafting and documentation is recommended, not mandatory. I would say that the principles have more or less become mandatory, because the lenders draw so much and investors draw so much guidance, as do the legal advisors, from that, given the stakeholders that are involved in pulling that together. The Act guidance, again, the link's in the slides if anybody wants to look at that, but if you just literally Google that, you'll be able to find that document. I think it's quite lengthy, it's about 70 pages, but it's a really helpful guide as to walking you through the principles. If anybody's got further questions, they'll likely be answered in there. So I think, to round off, just conscious of time, I think if you're okay, Andrew, I'll probably continue, and then so practical considerations, and again Brennan's touched on some of these. So what type of loan is appropriate for your organisation? Do you have a green project or a social project in mind? Can you accurately monitor and track how your money is used? Or does the SLL product provide you with the greater flexibility? I would say probably for 75% of clients' purposes, SLL will be the way to go at the moment. And that's reflected in the fact that there's so much SLL finance out there in the press compared to the social or green loans. Timing, Brendan's again touched on this. You need to engage early with your funders. Your funders, your relationship team will have an ESG team that sits behind them that will have to verify and check and scrutinise the information that you provide. Those teams are fantastic, and those teams are only getting better at the banks, but they naturally have processes that can take time to go through. They have got to be very careful that they're not seen to be greenwashing. They've got to be very careful that they're abiding by the principles, that they stand up to scrutiny. Again, we've touched on data. This is a key thing. Are you already capturing the data? The chances are you are capturing it in some form on some system, but are you capturing it centrally? If you are capturing it, is it reliable? Can it be externally verified? Is the program that it's contained in efficient? Does it work for you? Do you need additional software to monitor and report your compliance? There's a cost implication if you do. Verification. External verification is now a requirement. Who's going to verify your KPIs? In the first instance, the suggestion would usually be your auditors, but that will be a conversation with your bank as to whether or not your auditors have the capacity to do that, because we all know that audit capacity generally in the sector is quite strained at the moment. And do they have the necessary, expertise? Or does your bank say that actually your auditors can't give us an opinion on your performance against that KPI because that's far too technical and we need X expert? Reporting, The expectation is annual reporting at least, but on your use of proceeds products for a green or a social loan, you need to be tracking your drawdown, so that if your lender calls you and says, oh, you've made a drawdown, how's it been applied? You've got that information to hand. Margin ratchet. So do you just get the benefit of a reduction, or is there a penalty? And costs. There's a financial cost. Pulling your strategy together if you haven't got it. Obviously, there's the resourcing cost in terms of staff time as well. And if you're not capturing the data already, there's the cost of the programming or the personnel to input that data. So kind of a whistle-stop tour through the last part of the section, but I was conscious for us to have the time to discuss, but hopefully a good way to round off before questions and just to leave some thoughts, thought-provoking things to inform discussions, or if you're thinking about ESG finance.
That's great. That's really good. Wow, there's a lot of information there, and that will be available for our clients on our website, or we'll ask you if you would like the information, and then we can then send it to you. Again, obviously we're kind of running out of time, but if there's any burning questions from who's on the webinar, then please kind of pose it now. A question I want to just come to mind here: what's Homes England and what's the regulator doing about this? And shouldn't grants? I know you mentioned, Brendan, that it's going to be self-regulated, but yeah, and we always wait in the sector for regulation. But shouldn't our grant that we're getting to be linked to some form of this?
Yeah, I have had I've had conversations with the regulator. I haven't had conversations with Homes England, but the regulator has a fantastic line on this, which is, it says, look, we regulate for value for money, and we can't get the sector to do that properly. But, you know, actually, a voluntary system is an evolving system, and I think at some point central government will tell them to regulate on it, but by giving us space to define things ourselves, work out with the banks what to do, and I think the regulator is wary of saying the wrong things to the banking industry as well. You know, part of its job is keeping the confidence of the sector with the financial industry. So, you know, they don't want to put their big foot in it. So they're letting things evolve. They will put their foot in it when I think they can be sure-footed, keeping the analogy going. You know, so I think it's really, it is difficult for them. And the same with, you know, Homes England. I think, you know, Homes England does have conditions. You know, I think your EPCB, not EPCB is, you know, there, etc. But, you know, everybody who works in development knows that EPC is a load of nonsense anyway. So what we've got is use that as an example. We've tried to get rid of EPCs as a measurement in the SRS.
Right.
And the banks are going, no, because in owner occupation, that's the only measurement we've got.
Yeah.
And we know it's flawed.
Yeah.
It's a language we understand. So the finance sector's clinging to a KPI which is rubbish and doesn't help on the net zero journey. So it's just so interesting. If you've got to think, you've got a major stakeholder who you used to go to and say, I need 50 million, you know, can I have it by Monday? Cheers, thanks. And now they're going, hang on, before you do that, what are you using it for? What are you going to achieve with that? How are you going to measure that? How are you going to keep me informed of that? So you've just got to think, one of your stakeholders has woken up and now wants to know what you're doing with their money. That's actually more powerful than a regulator.
Yes, but sometimes to get things done, or at least grant, you know, should be a little bit of a funded or done it. Natalie, any comments on that?
No, I would just say, I think, as Brendan mentioned, I think the regulator's keen to avoid to be seen to imposing something at a stage where the market perhaps hasn't got its head round what the appropriate imposition might be. I think that's fair to say, Brendan. And I think we could use the time before it becomes a mandatory type of reporting requirement to hopefully shape what their opinion and their requirement might be. And that will be helpful. And the best people to do that will be the banks and the borrowers together. rather than the regulator, perhaps, would be my opinion.
Taking that story on, to a different part of this, and Natalie raised increasingly the banks will want this audited,
right.
And we're in the SRS, we're resisting that because there's a shortage of auditors. So, and actually, a lot of this is technical, and we do not want to create an industry for the big four audit companies. So, what we've said in version 2, of the SRS, which we're launching in October, is: are you auditing it? How are you auditing it? So we're raising the issue of audit it, and we're looking for innovation in that space. So if the sector can lead on what it's doing, whether it's peer review, whether it's an expert review on aspects, I think we can then get ahead of a regulator and get ahead of the market and give them comfort that it doesn't have to be the big four audit route as a solution for this. So that's the sector can do this and can get ahead of it.
I think all I'd add, just I'm conscious of time, is that Brendan and I have discussed this, was that if you are going out for ESG funding because of the margin reduction, that's the wrong reason, I think, isn't it, Brendan? Unless you've already got your well-developed sustainability strategy and you're already capturing your data, there's an upfront time investment to the negotiation with the funders. There's the reporting and the data collection aspect, and then verification. There's that additional cost, and the reductions, the margin reduction that you will be achieving if you meet those targets, won't necessarily feel like a big win. Will it, Brendan, comparative to the time and the financial and time cost? That's not to put you off that.
Lots of people who have done specialist loans have gone, well, it's too bureaucratic for it. This is, I think this is a general lending issue. I think that but just another point, Natalie, that you raised, which was really important, was on data. And data quality is something that needs closer attention, I think, because if you say, oh, in year 2 it's different from year 1 because we've got it wrong in year 1, or that's okay actually, because year 1's do. But if you're in year 5 or 6 and you're changing data, you're undermining your reputation big time. So attention to detail, large or small businesses have got to really get their heads around that and get that right, because that's how you're going to be judged. And just going one more step on this, there are 3 measurements which I think should be KPIs in every association, not for any loan, but that's scope 1 emissions, scope 2 emissions, and scope 3 emissions, which are 3 types of emissions of carbon, which are really hard to measure, particularly scope 3, but start measuring them now, because I think those 3 KPIs are going to be critical politically, regulatory, and financially going forward. So they're really tough to get your head round, but start thinking about them. We get within the sector, we've got wide disparity about how that is measured at the moment. That will emerge, be part of that journey.
Excellent, good. There's a lot of detailed information there that was really kind of handy and thoughtful. Thank you for your time of putting this together and coming on our webinar. I think I look forward to kind of catching up with you again and kind of following up on this subject matter, especially SRS reporting, Brendan. I think that'd be quite a good platform for our client base as well. So thank you. Our next webinar will be a little bit earlier next month. It'll probably be the 18th of October, just to avoid the half term. So look out for kind of information on that. And just again, say thank you very much, Natalie. Thank you, Brendan, for your time. I really, really appreciate it, and look forward to kind of working with you on future subject matter. So thank you.
Thanks very much.